When you hear the word audit, what do you picture? I'm guessing dusty books, calculators, maybe a really boring spreadsheet, right? Well, forget all that. Today, we're going to treat an audit like what it really is, a high-stakes financial investigation. We're telling a detective story, and every good investigation starts with a single crucial question.
I mean, that's the whole ballgame, isn't it? A company puts out a report that says, hey, investors, we made $1 billion. How do we know they didn't just pull that number out of thin air? That's the mystery that auditors, our financial detectives, are hired to solve. They're the ones who are supposed to separate fact from fiction.
And to show you how this really works, we're not going to talk about theory. Nope. We are opening up a real case file. We're going to follow a team of these financial detectives as they dig into the books of a very real company that's under some very real pressure. Okay, so what's the mission here? For our detectives, the primary objective is to figure out if a company's financial statements are, legit. Do they give a true and fair picture of what's actually going on, without any major errors that could trick investors?
So let's meet the company at the center of our investigation, Deimante Limited. They're an Australian outfit that pulls diamonds out of the ground, but things are not as shiny as they might seem. They are walking a tightrope, trying to fund a massive expansion while dealing with some huge business risks. The stakes here are incredibly high.
Now, what's the first thing any good detective does? They case the joint. They get the lay of the land, they figure out who's who and what the pressures are. Before an auditor even cracks open a spreadsheet, they have to understand the business, inside and out. And when our team started sizing up Deimante, they found plenty of reasons to be on high alert. And yeah, the list of worries gets long fast. First, the market is being flooded with cheaper synthetic diamonds. Big problem. Second, a whopping 40% of their sales come from just one customer. What happens if that customer walks away? On top of that, their board is weak with no real oversight from an audit committee. And here is the real kicker. They desperately need to raise $350 million for a new mine, and their current bank loan says they have to stay profitable. Talk about pressure to make the numbers look.
And this is where great detective work comes in, because you have to connect the dots. These aren't just abstract business problems. They could be financial time bombs. That competition from fake diamonds, it could mean the real diamond inventory is worth way less than they say. Relying on one big customer, that means the sales number they're reporting might not actually turn into cash. And the weak board, that's like having a faulty alarm system. It makes it so much easier for mistakes or even fraud to slip right through. So, our detectives have identified the risks. They know where to look for trouble. But here's a question. In the world of big money, how big does an error have to be to actually be a problem? Not every typo sinks a company. They need to draw a line in the sand.
And that line in the sand has a name: materiality. It's a really powerful concept. Basically, an error is material if it's big enough to potentially change an investor's mind about buying or selling stock. It's the difference between a rounding error and a reason to sound the alarm.
To figure this out for Deimante, let's start with the scale of the company. They're sitting on over $238 million in assets. That's a huge operation, so you'd think, for an error to matter, it would have to be, millions of dollars, right?
Well, think again. After looking at all the risks, our auditors set that final materiality threshold, that line in the sand, at just $317,000. That's the number. Any mistake or a bunch of smaller mistakes that add up to more than that is officially a big deal.
Let's just pause and look at this because it's wild. On one hand, you have a company worth almost $250 million. On the other, the threshold for a serious problem is just over $300,000. That means an error of just 0.13% of their assets is enough to potentially mislead investors. It really shows you that in auditing, even seemingly small numbers can cast a very, very long shadow.
All right, so the mission is clear and the line has been drawn. Now it's time for our detectives to go hunting for clues. This is where they roll up their sleeves and gather the hard evidence to see if the company's story actually checks out.
So what's in their detective toolkit? Well, a bunch of stuff. They do physical inspections. I mean, literally going and counting diamonds. They do external confirmations, which means calling the bank directly to ask, hey, does Deimante really have this much cash? They dig through documents like sales contracts and invoices. And they use analytical procedures, running the numbers to see if there are any weird spikes or dips that don't make sense. It's all about finding proof.
And they don't just take the company's word for it, especially on something tricky like the value of a diamond. In this case, Our audit team actually hired their own outside diamond experts to get an independent appraisal. It's like a prosecutor bringing in their own DNA expert to challenge the defense's claims.
And what did those experts find? Aha, a clue. Turns out management's value for its white diamonds was a little too high, and their value for the champagne diamonds was a little too low. You net it all out, and the auditors found that the company's inventory value was inflated by $50,000. Not a huge amount, but it's a solid piece of evidence.
Then they found something else, something bigger. Deimante was carrying a huge asset on its books related to finding a new mine, but the only way that asset was worth what they said was if you used, and I'm quoting the auditors here, very aggressive guesses about future profits. Our detectives redid the math with more realistic numbers and found the asset was overvalued by $180,000. This is a huge find because it's not just about math, it's about challenging management's judgment. Okay, the legwork is done. The evidence has been gathered. Now comes the moment of truth. It's time to put all the pieces together, weigh the evidence, and deliver the final verdict on the case. So here's the final tally of errors that management just flat out refused to fix. There was a small $15,000 error where they booked a sale in the wrong year. And then there's that big $180,000 overstatement on the new mine asset. The auditors presented these to management, and management basically said, nope, we're not changing it. So that leaves us with a total of $195,000 in uncorrected errors. This is the number. This is the evidence that the whole verdict is going to hinge on.
So let's ask the critical question. Does this $195,000 total cross that line in the sand we drew earlier at $317,000? And the answer is no, it doesn't. So, case closed. Clean bill of health, right? Well, not so fast, because the biggest bombshell was still to come.
Because sometimes the most terrifying thing a detective can uncover isn't a smoking gun, but a fundamental question about the future. The auditors found something so serious that it put Deimante's very existence into question. It's an issue that accountants call a going concern problem. Here are the facts that set off the alarm bells. Deimante had been losing money, and a lot of it, for 3 straight years. Even worse, their short-term bills were over $24 million more than the short-term assets they had to pay them. This led the auditors to a chilling conclusion. There was significant uncertainty that Deimante could survive for even another 12 months. So while the numbers weren't technically wrong enough to fail the audit, the whole picture was incredibly risky. The verdict? The auditors would issue a report, but they would add a special paragraph specifically to warn investors that this company might not be around for long. And that leaves us with one final big question. The auditors did their job, they found the problems, they assessed the risks, and they put up a flare for everyone to see. The report warns investors, but it isn't a full-blown 5-alarm fire. And for a company like Deimante, teetering on the edge between massive success and total failure, you have to ask yourself, is a quiet warning really enough?